I know many Palantir investors are feeling uneasy about the current pullback, but as a Palantir investor myself since November 2021, I am not worried about Palantir's long-term outlook. Palantir is well positioned for continued growth over the next 6 to 12 months, supported by both company-specific strength and favorable external trends. The recent share price decline should not be a cause for panic. The dip is driven by transitory news such as the defense budget talk, tariff war, and a general overcorrection of tech stocks. It was not by any weakening in Palantir's business. This is temporary. In fact, the fundamental outlook for Palantir is stronger than ever. Its government segment is surging with new contracts. 2024 revenue from the U.S. government alone was up 30% from 2023 to $1.2 billion. This includes major multi-year contracts such as a 3-year, $250 million U.S. Army contract to develop AI and machine learning applications for battlefield intelligence from 2003 to 2026, and a 4-year, $400 million to $619 million follow-on contract to power the Army's data analytics platform, Vantage, from 2025 to 2028. The annual contract value is recognized as revenue as the service is rendered. From my experience working with SaaS B2B companies, the bulk of the work occurs in the middle of the contract. And towards the tail end of the contract in the last year, the service provider will find opportunities to propose follow-on work. And it's difficult to switch SaaS service platforms, especially if the client's employees have been trained on the software platform. This is why we continue to see follow-on work with the Army that Palantir wins, and why, regardless of the government budget cutbacks, Palantir will continue to win the U.S. defense work. As for the 2025 revenue guidance, Palantir issued another 30% growth year over year. As CARP sees it, Palantir is at the very beginning of the upward growth trajectory and the AI revolution. They plan to drive the U.S.'s transformation over the next 3 to 5 years. Pete Segwith's announcement that the Pentagon will cut back 8% budget from its defense spending every year for 5 years drove Palantir's stock down. But Karp isn't worried. He firmly believes Palantir's product can deliver what the government needs and that the government needs Palantir. Prominent Wall Street analysts like Wedbush's Dan Ives and team believe that the defense budget cutback will actually benefit Palantir. They spoke to many of their DC government contacts over the last few weeks to get more insight on the government's new spending pattern, and in their view, Palantir's unique software approach will enable the company to gain more IT budget dollars at the Pentagon. This is positive growth catalyst for Palantir as CARP gets a bigger seat at the table in DC. Palantir is attached to many programs and contracts in the DoD that are safe and not at risk of getting cut in this new spending climate given their high priority. Palantir is in a position to benefit from federal spending on AI, while it's the other non-strategic areas of the federal IT budget that will get scrutinized and cut back. In their view, Palantir could be a $1 trillion market cap over the coming years. Palantir's commercial segment is also accelerating thanks to the AI platform adoption. Palantir's revenue skyrocketed 64% year over year in Q4 2024, evidence of booming demand from private sector clients to integrate Palantir's AI platform on the client's proprietary data to securely run large language models to help with decision-making analysis. Palantir is seeing unprecedented demand. In Q4, they closed a record $803 million in U.S. commercial contract value, up 134% from prior year. And remember, this is the total contract value, which we will see them recognize in revenue over multi-years. And going forward, Palantir expects U.S. commercial sales to grow by 54% in 2025. As Karp mentioned in his Ask Me Anything live session with retail investors in February, he is hoping to capture more of the European company sales, meaning the U.S. commercial sales is only just a small piece of the pie in terms of potential. One key difference between tech companies that have had a hard time recovering after overcorrections in the stock market and why Palantir today won't have the same problem is that Palantir is a profitable company already. In addition to their robust growth trajectory, they're showing improved profitability. 2024 marked Palantir's first full year of GAAP profitability. The net income was $462 million, which is a 16% margin. The company's operating margin has steadily improved as well, turning GAAP operating profit of $310 million for 2024. Palantir is also a cash-generating machine now. It produced $1.15 billion in cash from operations in 2024, a 40% cash margin. This strong cash flow, combined with a hefty $5.2 billion cash reserve on its balance sheet, means Palantir can self-fund growth and R&D, and even earn interest income in today's high-rate environment without needing external financing. For 2025, Palantir management has issued bullish guidance, projecting about $3.75 billion in revenue, a 31% growth, and expecting GAAP profitability in every quarter. Beyond their current AIP sales on track, Palantir continues to roll out new solutions and strategic alliances that could propel future stock growth further. The Palantir Gotham platform remains a staple for government intelligence operations, and it's evolving with more AI capabilities for defense customers. In the commercial realm, Palantir's Foundry platform is being enhanced with industry-specific modules, for example, supply chain optimization and healthcare analytics, that make it easier for enterprises to derive value quickly. Palantir's partnership strategy is also noteworthy. It is working with cloud providers and integrators so that its software can plug into broader IT environments. These partnerships demonstrate the demand of Palantir's technological solutions across various industries that are going to be catalysts to Palantir's growth trajectory. The broader macroeconomic backdrop is an important factor for Palantir's stock. High-growth tech stocks like Palantir often face headwinds when interest rates rise, as higher discount rates can depress the present value of future earnings. During 2022 and 2023, rising rates and Fed tightening contributed to volatility in tech valuations. But Palantir has a few buffers against this pressure. First, the company has no debt and over $5 billion in cash, so it isn't directly hurt by higher borrowing costs. In fact, that cash pile is largely invested in short-term treasuries, earning interest income that boosts Palantir's bottom line. Another contributing reason is Palantir's customers, especially government agencies. They are less sensitive to interest rate fluctuations than consumer-facing businesses. On the commercial side, Palantir's AIP can actually help companies save money, which is attractive in any rate environment. It's also worth noting that if the economy slows and the Federal Reserve eventually eases monetary policy, as some expect in late 2025 if inflation abates, growth stocks like Palantir could see a tailwind from multiple expansion. So while investors should monitor inflation and Fed moves, Palantir is relatively well positioned among tech stocks to withstand a high-rate environment. Its strong free cash flow means it won't need to issue debt or equity to fund operations. As a summary, let's look at the positive catalysts for Palantir from William Blair's analyst Louis DePalma, CFA, from their March 5th report. In spite of the 35% pullback to under $80 share price, they upgraded their outlook to market outperform due to these 5 reasons. 1. The February 26th DOGE executive order mandates centralized payment tracking systems. They will likely use Palantir's Foundry, AIP, and Databricks-powered Advana platforms. 2. Palantir's Q4 government bookings were back-end loaded, which means they will have a strong sequential Q1 growth with major deals like Army Next Gen Command and Titan expansion driving future revenue. 3. Due to persistent market enthusiasm for AI stocks, Palantir's premium valuation is becoming more widely accepted, with investors likely to continue assigning it an AI premium. 4. Government contracts are proving to be stickier than initially anticipated. For example, the U.S. Army and Space Force programs extended Palantir's agreement, suggesting stable follow-on revenue, as mentioned before. 5. Palantir's revenue has grown significantly with minimal headcount expansion, which shows exceptional operating leverage and proves that the company is positioned for margin expansion going forward. To sum it up, like the William Blair and Wedbush analysts, I have no intention of selling Palantir stocks in the short term. I see any further decline as an opportunity to buy the dip.